Welcome to the debate. Today we're diving into what is, well, arguably the most critical financial question facing the current generation of ambitious young investors. How do you achieve genuine financial independence when the traditional rule book just seems fundamentally broken by asset inflation and, systemic economic constraints?
Right. And the central question we're really tackling here is this. For an ambitious person, maybe with limited starting capital, is the only viable path to closing that wealth gap through aggressive high-risk speculation? Or does success still rely on disciplined, diversified, long-term passive investing?
Exactly. And I'll be arguing that the current economic structure basically forces younger investors toward high return, volatile assets simply to keep pace with soaring asset costs. This strategy isn't really about chasing reckless risk. It's more about matching the magnitude of the economic challenge itself.
And I'm going to maintain that discipline, robust risk management, and diversification, well, they remain the only sustainable routes toward building lasting wealth. My focus is really on managing the biggest variable of all, the investor's own behavior.
Okay, so the core problem that dictates my position is what I call the magnitude of the gap. We have scarce assets, right? Things like the S&P 500 or housing, appreciating at rates of maybe 12% to 13% annually.
Mm-hmm.
Meanwhile, salaries for the average worker, they only grow 2% or 3%. Now, this is a guaranteed loss for anyone attempting to save or just rely on wage growth alone. Traditional financial advice, get a job, save diligently, eventually get a mortgage, now risks actively making your future self poorer in terms of purchasing power parity. So if a young investor sees their future self just stuck in this loop of perpetual catch-up, then taking high risk becomes a logical decision, because the quote-unquote safe path is statistically guaranteed to fail to close that gap. And when we look at assets that can bridge this gap, well, the numbers kind of speak for themselves. Bitcoin's 145% average annual return since 2012, even with its extreme volatility, demonstrates the necessary magnitude of growth. That's 10 times the return to the stock market over that period. But, and this is key, this strategy only works if the foundation is strong. It means investors must first focus energy on exponentially increasing their income by, say, monetizing unique skills or investing heavily in their networks.
See, I reject the premise that extreme risk is the only logical solution. That view, I think, fundamentally overlooks the most common failure point for average investors, and it's behavioral mismanagement. Before we even think about chasing a 145% annual return, we have to address the epidemic lack of discipline and emotional control. I mean, the statistics are horrifying. 82% of Americans admit they actively avoid thinking about their finances. You simply cannot manage extreme volatility if you can't manage a basic budget. Wealth accumulation must start with eliminating high-interest destructive debt. I know people, for instance, carrying $40,000 in credit card debt at 15, even 20% interest. Until that's gone, no speculative investment on earth can compensate for that bleed.
Okay, debt's a killer, sure.
And furthermore, 65% of Americans have literally no idea what they spent last month. So once that behavioral baseline is established, once you actually have control, then passive investing in traditional assets becomes the most reliable strategy. Investing even, say, $1,000 a month for 30 years in the S&P 500, historically averaging 10%, reliably generates about $1.9 million. Statistically attempting to beat the market is, well, it's a fool's errand for most. Over 90% of actively managed funds underperform the S&P 500 after fees. Diversification across liquid assets is essential precisely because high volatility forces emotional selling when an economic downturn hits, and maybe your income is compromised at the same time.
I appreciate the focus on behavioral risk, I do. But that view fundamentally underestimates, I think, the psychological damage and, frankly, the liquidity crises caused by inaction when time is the primary variable. My argument really rests on the fact that volatility is perfectly acceptable for the young investor, because time is their most critical financial input. Look, if an investor experiences a massive drawdown at age 25, they have their entire lifespan ahead to compound back. The real risk is waiting until you're 50 to take action when time is suddenly very scarce. The high returns potentially available in these exponential assets justify the deep drawdowns, in my view. The investor's primary job, therefore, isn't to avoid risk altogether, but to implement structural, automated habits, like dollar-cost averaging. This forces them to remove emotion from the equation, ensuring they buy more during those dips, lowering their average costs, and enabling the rapid compounding we established is necessary.
But this is exactly where your theory crashes headfirst into reality. The psychological toll of watching your portfolio evaporate by 70%, even if you are only 25, cannot just be rationalized away by structural advice. People panic, they liquidate positions during crashes, and that single emotional decision completely undermines the very long-term thesis required for those high-risk assets to recover and actually pay off. We know the key to successful long-term compounding is removing emotion entirely. I mean, the famous example being that the best-performing brokerage accounts often belong to people who are, well, deceased, because they can't meddle. Your strategy requires a kind of cold, calculating resolve that the average investor who's already facing financial stress and maybe debt, they just don't possess. So, if we accept the need for automation to remove emotion, shouldn't we use vehicles that require less emotional sophistication in the first place? If we agree, perhaps, that the traditional 10% S&P 500 return might be a bit too slow to meet modern independence goals, then let's seek higher growth within a manageable risk framework. For growth-focused investors, the NASDAQ 100, for example, offers a superior, liquid, zero-cost growth vehicle compared to the broader S&P. It compounds closer to, 18% annually on average?
Historically, yes.
And that difference is massive over time. Achieving a target like $100,000 is shortened from nearly 8 years down to about 5.5. This provides the acceleration needed without forcing the investor into the catastrophic downside risk of single asset speculation or the extreme volatility you're advocating. It's a powerful path that minimizes single asset risk while maximizing equity market growth potential.
Okay, while the NASDAQ 100 certainly offers attractive returns, it's not immune to what I call time risk. We saw extreme historical risk there too, right? In the early 2000s, the NASDAQ index crashed. What was it, 78%? That meant investors waited 15 years just to break even. 15 years of emotional endurance and stagnant capital is, well, it's mentally exhausting and completely defeats the purpose of rapid wealth accumulation for a young person. Crypto, specifically digital networks, is fundamentally different, I believe, from a stock index. It operates on a technological network adoption model. It's driven not by quarterly earnings or interest rate cycles, but by accelerating global user adoption. Its growth trajectory has actually been observed to be twice as fast as the internet's initial adoption curve. This underlying technological necessity, combined with the secular bull market, driven by, let's face it, continued currency debasement, makes it a potentially predictable high performer that will, in my view, continue to vastly outperform traditional cyclically exposed indices.
Well, I remain skeptical that any asset class can maintain that kind of performance indefinitely without eventually succumbing to, say, regulatory or competitive pressures, which introduces its own, perhaps more complex, form of risk. We need a sustainable framework that actually allows for career flexibility down the line. The goal shouldn't just be, $1.9 million by age 60. Perhaps it should be achieving something like coast fire. This is the point where you have a sufficient nest egg, let's say $150,000 by age 35, invested passively, which will then naturally compound into maybe $1.5 million by traditional retirement age without requiring any further savings contributions. This approach relies heavily on disciplined front-loaded savings and robust expense control, allowing the individual freedom of choice in their later career stages. Aggressive gambling risks sacrificing that essential early safe harbor nest egg entirely.
I see the appeal of coast fire as a concept, that idea of optionality. Definitely. But I maintain the data suggests the main lever for generational wealth acceleration isn't your cost basis, it's income and opportunity. Coast-fire is only really viable if the initial income allows for that rapid saving in the first place. If we're talking about an ambitious individual starting with limited capital, the best investment they can make is often in themselves. Investing disposable income in self-improvement, maybe a $150 AI course to gain knowledge arbitrage in a rapidly changing labor economy, or actively building a strong network. That offers the quickest and most controllable way to accelerate capital formation. We have to focus on the inflow, not just the outflow. And the system, as I said, should remove emotion through structural habits like dollar-cost averaging, allowing the investor to take advantage of high-performing assets without the paralyzing fear of trying to time the market perfectly.
Mm-hmm.
And we also need to touch on the traditional dream, right? Buying a primary residence. It really should be viewed primarily as a lifestyle decision, not a reliable investment strategy to close the wealth gap. When you actually factor in high interest rates and the mechanics of mortgage amortization, for the first 15, maybe 20 years of a 30-year payment, the payments are overwhelmingly just interest, not true equity building. That capital is locked up, it's illiquid, preventing the very investment in high-growth assets that might be necessary to accelerate wealth. The opportunity cost there is immense.
Yeah, that's a critical perspective on housing, and it ties directly into my behavioral framework. Illiquid debt is destructive. However, while a mortgage might be, let's say, poor use of capital from a pure growth perspective, it absolutely pales in comparison to the financial crippling effect of high-interest consumer debt, like credit cards or personal loans. That kind of debt must be addressed with, frankly, extreme sacrifice before any investment is even considered. And we have to confront an uncomfortable truth sometimes. Bankruptcy, while heavily stigmatized, is often a rational financial strategy. It can lead to better long-term financial performance than years of prolonged avoidance of unpayable, spiraling debt. The best investment, initially, is often the complete, decisive elimination of destructive debt.
So, to conclude then, my position remains pretty firm. Given the economic reality where traditional saving basically guarantees loss and salaries just cannot keep pace with asset inflation, high-risk, high-return assets become the logical, though yes, psychologically demanding, means of achieving financial freedom. The path requires leveraging unique skills to accelerate income, building network equity, and using the luxury of time to structurally absorb the necessary volatility.
And my analysis concludes that a sustainable path has to prioritize discipline, risk management, and diversification. Index funds like the NASDAQ 100 can offer highly competitive returns with reduced individual asset risk. But long-term success ultimately depends on the investor's ability to automate sound financial behavior, eliminate all destructive debt, and maintain emotional composure. That ensures a clear runway to financial independence.
So I think the material makes it clear that different economic starting points and different risk tolerances really lead to radically different, yet, entirely credible strategies for tackling the immense and very modern challenges of wealth creation.